What if you could trade the stock market without staring at charts all day, but still take advantage of important price moves? Swing trading may sound simple: buy a stock, wait for it to rise, then sell. But the reality is very different. Without a plan, one bad trade can erase weeks of progress. In this video, I'll show you how swing trading works, how to find potential setups, how to manage risk, and the mistakes beginners must avoid. What is swing trading? Swing trading is a short to medium-term trading style. Instead of holding a position for only a few minutes, a swing trader may hold it for several days or weeks, trying to benefit from a price movement, or swing. A swing trader is not trying to predict every move in the market. The goal is to find a setup where the potential reward justifies the risk, enter according to a plan, and exit when the trade reaches a target or the original idea is no longer valid. Swing trading is different from long-term investing. A long-term investor may hold a diversified fund or stock for many years. A swing trader is usually focused on a specific price movement over a shorter period. Neither approach is automatically better. They require different skills, time commitments, and risk controls. Step 1. Choose the right market. A beginner should avoid jumping between hundreds of markets. Start with liquid stocks or exchange-traded funds that have substantial trading volume and relatively tight spreads. Liquidity matters because it can make it easier to enter and exit a position. A thinly traded stock may appear attractive, but you could have difficulty getting a fair price when the market moves quickly. Be cautious with highly volatile penny stocks, leveraged products, options, and stocks promoted by anonymous accounts online. A dramatic chart does not mean a good trading opportunity. Before trading any security, understand what the company or product is, how liquid it is, when it trades, what fees apply, whether it can be bought or sold easily, how much it can move in a normal day. Step 2. Understand the trend. Many swing traders begin with a simple question: is the market trending upward, trending downward, or moving sideways? In an uptrend, price often creates higher highs and higher lows. In a downtrend, it creates lower highs and lower lows. In a sideways market, price may move between a defined range without a clear direction. This does not guarantee what happens next. Trends can reverse without warning. Technical analysis is a framework for organizing information, not a crystal ball. You can use a clean chart with price candles, volume, and perhaps one or two moving averages. Avoid adding so many indicators that the chart becomes impossible to understand. If 5 indicators give 5 different signals, you may have created confusion rather than an advantage. Step 3. Build a trading setup. A setup is the specific condition that tells you a trade may be worth considering. For example, a trader might look for a stock in an established uptrend, a pullback toward a previous support area, lower selling pressure during the pullback, a strong price reaction showing buyers are returning, enough room for a realistic profit target. Another trader may use a breakout strategy, looking for price to move above a clear resistance level with increased volume. There is no perfect setup. The important point is to define your rules before entering. Write down what must happen before you enter. Where will you enter? Where is your stop level? Where is your target? What would prove your idea wrong? How much will you risk? If you cannot answer these questions, you may be reacting to a chart instead of following a strategy. Step 4. Plan the trade before you enter. A trade plan should be created before clicking buy. Imagine a stock is trading at $50. You identify a possible entry at $50, a stop level at $48, and a target at $54. Your planned risk is $2 per share, while your potential reward is $4 per share. That creates a potential risk-to-reward ratio of 1 to 2. But a ratio does not make a trade profitable by itself. The setup may fail, the target may not be reached, and costs can reduce the result. The key is to decide the exit rules in advance. If you move your stop farther away simply because you do not want to accept a loss, you are changing the trade after the market has already disagreed with you. Step 5. Position sizing. Position sizing is one of the most important parts of swing trading. You should decide how much of your account you are willing to lose if the stop is reached. Many traders use a small fixed percentage, such as 0.5% or 1%, but the correct amount depends on your personal finances, experience, and risk tolerance. Here is the basic calculation: position size equals maximum dollar risk divided by risk per share. Suppose your account is $10,000 and you decide that your maximum risk is 1%, or $100. If your entry is $50 and your stop is $48, your risk per share is $2. Your position size would be $100 divided by $2 equals 50 shares. If the stop is triggered, the planned loss would be approximately $100 before fees and slippage. This is very different from saying, I always buy $1,000 worth of every stock. A fixed dollar position can create completely different risks depending on how far away the stop is. Never risk money you need for rent, bills, emergencies, or essential goals. Step 6. Stop-loss orders and gaps. A stop-loss order is designed to help you exit when price moves against your plan. But a stop price is not a guaranteed execution price. During fast markets, a stock can move through your stop before an order is filled. Overnight news can also cause the stock to open far below your stop level. This is called slippage or a gap. FINRA warns that stop orders can execute at prices materially different from the selected stop price during volatile conditions. A stop is not a magic shield. It is one part of a risk management plan. You should also understand the difference between a stop order and a stop limit order. A stop limit order may give you more control over price, but it might not execute at all if the market moves past your limit. Learn how your broker handles each order type before using real money. Step 7. Avoid excessive leverage. Leverage means using borrowed money or products that magnify market exposure. It can increase potential gains, but it can also increase losses rapidly. With margin, you may lose more than you invested, face a margin call, or have positions sold by your broker without choosing the timing. The SEC warns that leveraged investing can lead to losses greater than your initial investment. For beginners, trading without leverage is usually easier to understand and control. If you cannot manage a strategy with a small cash position, leverage will not fix the problem. It may simply make mistakes more expensive. Options, leveraged ETFs, short selling, and contracts for difference can carry additional risks. Do not use them until you understand how losses, expiration, financing, and liquidation work. Step 8. Watch for catalysts. Stocks can move sharply because of earnings reports, economic data, interest rate decisions, product launches, lawsuits, or unexpected news. Before holding a position overnight, check the upcoming calendar. An earnings announcement can cause a large gap in either direction, even if the chart looked perfect the day before. A trader may choose to avoid holding through major events, reduce the position size, or accept the additional risk as part of the strategy. There is no universal answer, but the decision should be made before the event, not in panic after the price jumps. Step 9. Control your emotions. The biggest challenge may not be reading a chart. It may be controlling yourself. After a winning trade, you may feel unusually confident and increase your position. After a losing trade, you may try to win the money back immediately. This is called revenge trading. Other emotional traps include fear of missing out, moving stops, taking profits too early, holding losses too long, overtrading after a bad day, trading because you are bored. Create limits before you begin. For example, set a maximum number of trades per day or a maximum daily loss. If you reach the limit, stop trading and review what happened. A missed trade is not a loss. You will always see another chart later. Protecting your capital is more important than participating in every move. Step 10. Keep a trading journal. A trading journal turns random activity into something you can study. For every trade, record the date and time. The security. Your entry and exit. The reason for entering. The stop and target. The position size. The result. Whether you followed your rules. What you felt before and during the trade. A chart screenshot. Do not only record whether you won or lost. A profitable trade can still be poorly executed, and a losing trade can be well executed. After 20 or 30 trades, look for patterns. Are you entering too early? Are your stops too tight? Do you perform worse during certain market conditions? Are your losses larger than your wins because you move stops? Your journal should help you improve the process, not encourage you to gamble more. Step 11. Practice before going live. Before using real money, consider paper trading or using a simulator. This allows you to test whether you can follow your rules without risking capital. But paper trading is not exactly the same as live trading. Real money creates emotions that a simulator may not reproduce. You may also experience different fills, spreads, and slippage. When you eventually trade live, start with an amount small enough that a loss will not damage your finances or your mental health. Your first goal should be consistency and proper execution, not fast profits. Common beginner mistakes. The first mistake is believing swing trading is easy because a chart looks obvious after the move has already happened. The second is copying trades from social media without understanding the original plan. The third is risking too much on one position. The fourth is using leverage before learning basic risk management. The fifth is trading too often. More trades do not automatically mean more opportunity. They can simply mean more fees, more stress, and more chances to break your rules. The sixth is confusing a winning trade with a good strategy. One lucky trade proves almost nothing. A strategy needs to be tested across many situations, including losing periods. A simple beginner framework. Here is a simple framework you can study. Select liquid stocks or broad ETFs. Identify the overall trend. Wait for a setup you understand. Define entry, stop, and target before entering. Calculate position size from your maximum risk. Check upcoming news and earnings. Avoid leverage while learning. Accept that losses are part of trading. Record every trade. Review your results regularly. This framework does not guarantee profits. It simply gives you a repeatable process. Final message. Swing trading is not about finding a secret indicator or predicting the market perfectly. It is about managing uncertainty. You will be wrong sometimes. A good trader is not someone who never loses. A good trader knows how much can be lost, exits when the idea fails, and avoids allowing one mistake to destroy the account. Before you place your first trade, ask yourself, can I explain my setup? Can I calculate my risk? Can I accept the loss? Do I have a clear exit plan? If the answer is no, wait. More preparation is better than a rushed trade. The market will still be there tomorrow. Your first job is not to make money quickly. Your first job is to survive long enough to learn. This video is for educational purposes only and is not financial advice. Swing trading is risky. You can lose some or all of your capital, and leverage can cause losses greater than your initial investment. Past performance does not guarantee future results.